When it's moving down, it searches for new buyers. Moving up, it searches for new sellers. Let's get ready to rumble. What's up, guys? It's Mr. Fit to Flourish, and welcome to the Fit to Flourish podcast. Today, I wanted to talk a lot about auction market theory. So, auction market theory tells us how markets move and why they move in the directions and speed that they do. So, let's get right into it. So, auction market theory is basically it's a system of ideas that dictates how prices of an asset or equity react to market events. And it's a theory that was developed by Pete Steidelmeyer in the 80s, and it was popularized by Jim Dalton. And basically, it states that price trades at what's called a fair value, and that's basically where buyers and sellers agree that they are getting the best bang for their buck. So a market event then takes place, and this is something like earnings, news, or a black swan event, or war, elections, disaster, COVID, things like this. So major things happen that causes people to react in how they're investing. And then this has an effect on the asset price, which causes a big move up or a big move down. So in the case of COVID, it caused a massive panic and people started to sell, or in war, people start to sell. But if there's good news, like Elon Musk is making a brand new flying car, then prices are going to start to go up because people are going to want to buy and invest in that company. So prices move directionally like this in imbalanced market. When it's moving down, it searches for new buyers. Moving up, it searches for new sellers. Price moves in search of new buyers or new sellers. Price then finds a fair value again, and the process repeats. Prices move tightly around the fair value in balanced markets, okay? So whenever you have massive movement to the upside or massive movement to the downside, that is considered order imbalance. So in this example, we're talking about Michael Jordan's shoe company. Price is trading at a fair value here down at the bottom, okay? Then Michael Jordan announces that he is signing a major deal with another company for the shoe company. Price then starts to fly to the upside, and it goes up in search of new sellers. So it's like, hey, when are people going to start to sell? Well, no one's selling. Everyone's buying. Then we start to trade sideways because we have now found a new fair value. And buying and selling is balanced here. We then get a market event again, which is, in this case, sometimes it can be that people buy the news and then sell the rumors. So the news was out and then they signed the deal, and now there's nothing new happening. We get another market event, and then the stock starts to sell off again. And it sells off in search of new buyers. And this process sort of repeats up and down, back and forth, until another market event occurs. Lesson summary: auction market theory is a framework that governs how asset or equity prices respond to market events. Here's a breakdown of the key concepts. So price trades at fair value, agreed upon by buyers and sellers as optimal. Market events like earnings reports, news, or unexpected incidents impact prices significantly. In imbalanced markets, price moves directionally in search of new buyers or sellers. So again, order imbalance would be something like this: massive movement very quickly, like a very steep incline. That's order imbalance. And then price tries to balance out at the top here. As you can see, it starts to go sideways. Prices eventually reestablish fair value, repeating the cycle, while balanced markets see prices closely aligned with fair value. For instance, consider a scenario related to Jordan. So prices at fair value before Michael Jordan announces record sale projections and earnings. Price spikes as buyers seek a new fair value. Price stabilizes around this new fair value until a subsequent market event causes a reversal. Sellers come in and prices drop to a new fair value, often around the 61.8% of the initial move. Buyers re-enter at this lower point, propelling the price higher than previous highs. It is worth noting that prior highs can act as resistance due to lingering sellers in that range. I hope you guys enjoyed this video. Really taking what I said here is a lot to take in, but this is pretty much how price action moves and how the markets move. Thank you so much for tuning in. It's the Fit to Flourish podcast. I'm out. Peace. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.